Hello everyone, welcome to this chapter overview video on chapter 13, which is our last chapter in financial accounting. So this chapter is all about stockholders' equity and corporations. And so our learning objectives are to identify the characteristics of a corporation, journalize the issuance of stock, account for the purchase and sale of treasury stock, account for dividends that are cash dividends and stock dividends, as well as stock splits, and then we're going to look at how equity is reported for a corporation. You'll see some of the things here are review from topics that we've looked at earlier in the course. So let's talk about some of the characteristics of a corporation. Of course, a corporation is a separate legal entity, which makes it different than, say, a sole proprietorship or a partnership. The number of owners in a corporation, this is important because sometimes students think that corporations have to be big, large entities such as like a Walmart. But, you know, a mom and pop store down the street could be a corporation, or any local company could also be a corporation, and that would only have a few stockholders or owners. And it would be a privately held corporation as opposed to public, which is listed on a stock exchange and anybody can buy shares. Corporations have limited liability. That means if you do go buy a share of, say, Apple stock and something happens to Apple or any other corporation you own stock in, you are not responsible for their debts. A corporation has indefinite life, so of course stockholders buy and sell shares all the time, and the corporation just keeps going. And then finally, double taxation means this: a corporation pays taxes on its income. So a corporation files a tax return just like individuals do in the US, and the corporation files a form called 1120, and that corporation pays tax on its income. Then it distributes that income in the form of dividends to its stockholders. And guess what? If you're a stockholder and you get dividends, you have to pay tax again. So even though that money was already taxed, that income was taxed at the corporation, you also pay tax when you receive the dividends. Now, there are three different numbers when it comes to shares of stock: authorized, issued, and outstanding. And treasury stock is involved here. So the biggest number here, this outside ring, is the number of shares of stock that has been authorized. So that is the total number of shares that a company can issue at any time. The total number of shares that they're allowed to issue. Okay. In the middle, we have stock that is authorized and issued. So that means the shares have been sold to stockholders. And in the middle is authorized, issued, and outstanding. So really the outstanding stock, the stock that's still in the hands of the stockholders. And the difference between issued and outstanding is the number of shares of treasury stock, which we're going to take a look at soon. Treasury shares are shares that the company issued to stockholders and then bought back again. Now, stockholders' equity is the equity in a corporation, and that has two different main sources. The first source is paid-in capital, and paid-in capital is all the amount of money that stockholders have paid into the corporation, and that includes common stock, preferred stock, and paid-in capital in excess of par. And we're going to be taking a look at all of these. And then our old friend retained earnings, which we met all the way back at the beginning of this course. Retained earnings, as a reminder, includes all of the net income the company has earned but has not paid out in dividends over its whole life. So those two pieces added together give us stockholders' equity. Let's take a look now at how to record the issuance of common stock. And you did look at this in a simplified form back at the beginning of this course, but let's talk about something we haven't spoken about before, which is that stock can have a par value, no par with a stated value, or true no par. It has no dollar at all associated with it. So a par value is simply a number that is associated with each share of stock. And many big corporations have very small par values associated with their stock. I think if you look at Apple, I can't remember how many zeros it is, but it's 0.0001. So less, way less than a cent, right, per share. But most of the shares we look at, we simplify this and make it like $1 a share or something, just so that it's easier. But a par value is a dollar amount or stated value that is associated with the share of stock. It has no relation to the market value, so that's important. Okay. True no par stock has no par value at all. So if you have par value stock, you credit common stock when you issue it for the total par value or stated value of the shares you issued. If it's true no par stock, you put the whole issuance price right into common stock. So let's see how that works. Let's say a company issues 10,000 shares of $1 par value stock for $25 each. All right, so the company is going to make a journal entry. It has 3 pieces to it. It's going to debit cash for the issuance price. Okay, this is the issuance price. We're issuing the shares at $25 each, and we're issuing 10,000 shares. We're crediting common stock for the par value of the shares we issued. So we issued 10,000 shares. They have a $1 par. That gives us $10,000. The rest goes into paid-in capital in excess of par. That's the amount we issued the shares for over par value. So this is a new account. It's exactly what it sounds like, right? It's how much paid-in capital there was in excess of the par value. So generally, when we're issuing stock, it's going to look like this. And when we look at preferred stock, it's the same, only we have the word preferred instead of common, unless the stock has no par at all. Now, if the stock had no par at all, you would just record the whole thing for the issuance price. So you're going to debit cash for the 10,000 times the $25, and you're going to credit common stock for the same amount. Now let's talk about preferred stock. Preferred stock is a different type of stock. Generally, preferred stockholders give up their voting rights. It's a little less risky than common stock because preferred stockholders are paid first, both in dividends and distribution of assets. So if the corporation pays dividends, they have to pay dividends to the preferred stockholders, then they can pay dividends to the common stockholders. And if it turned out that the company was liquidated, preferred stockholders get paid before common stockholders. And remember I mentioned that recording the issuance is the same as common stock, only instead of crediting common stock, you credit preferred stock. Now, preferred stock dividends are often expressed as a percentage of the par value. So, for example, 5% $100 par value preferred stock pays, take your $100 par, multiply by 5%, $5 per year per share. Okay, so the 5% tells you it pays 5% of the par value per year. It could also be, this could also be a dollar amount. So it could just be $5 100 par value preferred stock, and that tells you that the $5 is the amount of the dividend. Now, preferred stock can be cumulative or non-cumulative. Cumulative means that if the company does not pay preferred dividends one year, then the company has to make up those dividends in future years before they pay common stockholders. Non-cumulative just means that if they don't get paid their dividends one year, the preferred stockholders do not get their dividends made up in future years. Let's see how this works, cumulative versus non-cumulative. So let's say we have 6% preferred stock with $100 par value, 1,000 shares issued and outstanding. And we have common stock with $1 par value, 100,000 shares issued and outstanding. The company pays $10,000 in dividends in 2025. Preferred stock is non-cumulative. Okay, so remember, preferred stockholders get paid first. So every preferred stockholder is going to get paid 6% times $100 times 1,000 shares. So the preferred stockholders are going to get paid a total of $6,000. And remember, once they're paid, then whatever is left gets paid to the common stockholders. So the common stockholders are going to get the total of $10,000 minus the $6,000 paid to the preferred. So the common stockholders get paid $4,000. Now let's see what happens with cumulative stock. So we're looking at the same stock here, but now instead, let's say that the company pays $20,000 in dividends. Preferred stock is cumulative, and 2024 dividends were not paid. So remember, if it's cumulative and the dividends weren't paid last year, they have to make up those dividends before paying common stockholders. So in this case, the preferred stockholders, again, remember they get $6,000 per year, but they are going to get paid 2 years. So the preferred stockholders get paid, this includes 2024 and 2025. Once those two amounts are paid, then the common stockholders can get paid. So the common stockholders get the rest. So there's $20,000 paid in total, minus the $12,000 for the common stock, gives them $8,000 for the common stockholders. Now let's talk about treasury stock. So remember I mentioned that treasury stock is the corporation's own stock that it has issued and then it buys it back again. And the purchase of treasury stock is recorded at the cost of the shares that were bought back. Let's say that a company purchases 100 shares of its $1 par value stock for $5 per share. So it's going to debit treasury stock for the cost of the shares. So 100 times 5, or $500. This is a new account we haven't seen before. It is a contra stockholders equity account. It reduces stockholders equity. Now sometimes students get confused and they think this is an asset because it's a debit balance account. It is not an asset. Treasury stock is a contra equity account. All right. So when the company buys back stock, you debit treasury stock for the cost of the shares and you credit cash. Now let's say the company reissues those shares. So it's going to pay those, it's going to issue those shares again. And this might look similar to the common stock that we looked at before. So the company is reselling 50 shares of its $1 par value treasury stock for $6 per share. Now, be careful here. The cash is how much they're selling it for, right? $50, they're receiving cash of $6 per share. So they're receiving cash of $300. They're going to credit treasury stock for the cost of the shares. Notice we are ignoring par value here, right? We're crediting treasury stock for the cost, the original cost of the shares. The original cost of the shares was $5 per share. Credit treasury stock, 50 shares times $5 gives you $250. Credit paid in capital from treasury stock transactions for the rest. So this is a new paid in capital account, and it's the difference between how much you sold the shares for and how much you bought them for. Now, for now, to keep it simple, let's just assume that if the company sold the shares for less than what they bought them for, we would just debit paid in capital from treasury stock transactions. If you run out of that, you're going to have to debit retained earnings. Okay? Now, let's look at cash dividends, and stock splits. Remember, retained earnings is all the net income minus all the dividends paid since they started in business. Dividends are a distribution by a corporation to its stockholders. They can be dividends in the form of cash, stock, or property. Property is kind of unusual. We're going to look at cash and stock here. Dividends are not required. So if a company borrows money and has to pay interest, that is a required payment, right? But a company never has to pay dividends. So once they're declared by the board, they become a liability. Then they have to be paid. But no company is ever required to pay dividends. Now, you might buy stock in a company that has paid dividends, say, every single quarter for the last 20 years. And, you know, it's pretty likely that you're going to get dividends from them. But they're still not required. Okay. So there are 3 dates with dividends. The first date is the declaration date, and that's when the board of directors says, okay, we are going to pay X amount of dividends to stockholders of record on this date. And so the board of directors says we're paying a dividend. That's when the company has a liability. The date of record is the date on which stockholders receive the dividend. The date that stockholders have to be holding the stock, owning the stock in order to receive the dividend. So if you're a stockholder and you own the stock on the date of record, you're going to get the dividend. And then finally, the payment date is the date that the dividend is paid in cash to the stockholders, or stock is distributed to the stockholders if it's a stock dividend. Let's look at an example. So on January 1st, a company declares a 10 cents per share dividend on its 20,000 outstanding shares to stockholders of record on February 1st to be paid on March 1st. So on January 1st, that's the declaration date. The company debits dividends, credits dividends payable for the 20,000 times the 10%. Notice it's outstanding. It's the number of shares outstanding. That's important because, of course, the company is not going to pay itself. So if there are shares in treasury, the company doesn't pay itself. All right, then remember, anybody holding the stock on February 1st gets the dividend, but that is not part of anything that's recorded in the journal. In the journal, the last thing we're going to record is the payment, which is on March 1st. Company is going to debit dividends payable, credit cash, just like it does for any other liability that it pays, right? Debit the liability, credit cash. Now, a stock dividend and a stock split are both similar in that they're issuing additional shares of stock to the current stockholders. A stock dividend is taken from retained earnings like a cash dividend. And there's 2 kinds of stock dividends, large ones and small ones. The small ones are the ones that are up to 20 to 25% of the current outstanding shares. And that is recorded at the market value of the shares, which we're going to take a look at. A stock split, you're just taking, so as let's say it's a 2-for-1 stock split, you're just taking the number of shares and doubling it and issuing more shares. There is no journal entry because the par value per share is decreased proportionately. Let's look at a stock dividend example. Let's say a company has 10,000 shares of $1 par value common stock issued and outstanding, and the company declares a 15% stock dividend when the stock is selling for $24 a share. So the company is going to issue 10,000 times 15% more shares. Okay? So the company is going to debit stock dividends for the 10,000 times the 15%, which is 1,500 shares, times the market price right now, which is $24 per share. So that gives us a $36,000 debit. Stock dividends distributable is credited for the par value of the shares that are going to be issued. So that's 1,500 times 1. And then the rest goes into paid-in capital in excess of par. Now, when the dividend is distributed, this amount here, the stock dividend distributable, just goes into common stock. So they debit the stock dividends distributable and they credit common stock. Why can't they just credit common stock here? Well, remember, there's a time lag between the time that the dividend is declared and the time when the dividend is actually distributed. All right, so let's look at a stock split. Let's say a company has 100,000 shares of $10 par value stock outstanding. So it has $1 million of stock showing on its balance sheet. Let's say the company is 2-for-1. We're saying a 2-for-1 stock split. And so now 100,000 more shares of stock are issued. So 2-for-1 means for every 1 share you had before, you will now have 2 shares. So after the split, the company has 200,000 shares of stock. The par value is cut in half. So the par value is now $5. And the balance sheet is showing $1 million still. There's no journal entry, no debit or credit. There's no change in the stockholders' equity. The only change is the number of shares and the par value when there's a stock split. Okay? And oftentimes what happens is stock splits are beneficial to stockholders because they split the stock and then the price after that tends to go up. All right, now let's look at let's look at this here. This is a statement of stockholders' equity, and it has some new things in here. Remember that a statement of stockholders' equity shows your beginning balance, issuances of common stock. In this case, we have a purchase of treasury stock, declaring dividends, reselling treasury stock, and then the net income for the year. So the tricky thing here is you need to make sure that things come in and out of the right column. So for example, when the company issued the stock, it issued it for $4,030,000. 65,000 of that went into common stock. That was the par value. The rest went into paid-in capital, additional paid-in capital, or paid-in capital in excess of par. When they bought the treasury stock, that came out at cost. That is a new column here, right? That goes in the treasury stock column. Notice that doesn't affect our common stock. That's treasury stock. When they declare dividends, that comes out of retained earnings, because remember, dividends are closed to retained earnings. We forgot to mention that before, right? So the dividends, you have that dividend account, and when you get to the end of the year, the dividends reduce our retained earnings, right? So here is our dividend declaration. They resold the treasury stock, and here we just put everything into additional paid-in capital. The treasury stock is going, really, it's getting reduced, but it looks like a positive number because it's reducing our negative number, right? And then our net income is added to retained earnings. And then these are just all added down, and everything that you put in one of these columns goes across here to the statement, the total stockholders' equity column. All right, so then finally, what you end up with is on your balance sheet, a stockholders' equity section. And this is how everything looks on our stockholders' equity section. Your preferred stock is listed first. The number of shares issued and outstanding should be included. Then we have common stock and additional paid-in capital, which is the same as the paid-in capital in excess of par. Add all those together and we get our total paid-in capital. And actually remember that the additional paid-in capital might also include, in this case, the treasury stock. Add in your retained earnings. At the very bottom, we take out our treasury stock, 1,000 shares at cost, and add all of these up and subtract your treasury, and you get total stockholders' equity. Okay, that was a lot. Feel free to replay this if you need it. There are a lot of small topics in this chapter. I hope you find this helpful, and I'll see you in the next video.